I'm going to do an Excel question, and it's going to cover just how to calculate when lease payments change partway through. So in this case, we have X company signs a lease for equipment for 10 years. For the first 5 years, the lease payments are $100,000 due at the beginning of the year, January 1st. For the last 5 years, the lease payments are $58,000 due at the beginning of the year, January 1st. If the company had borrowed the money to purchase the equipment, it would have had to pay 10% interest. The very first thing I want to do is I want to kind of show what it would look like if we looked at the lease payments over time. I already created this, so I'm just going to copy and paste it here. There we go. And I'm going to shrink this down just a tiny bit so that we can see the whole thing. We can see that at the beginning of year 1, we're going to pay $100,000. Same as the beginning of year 2, 3, 4, 5. In year 6, at the beginning of year 6, we're going to pay $58,000. We're going to pay $58,000 at the beginning of every year for 5 years. And keep in mind, when we look at this final year, we're going to be able to have that equipment. We're still leasing that equipment. We actually only have to give it up at December 31st at the end of year 10 because we're making lease payments at the beginning of the year. All right, let's look at our first question. I'm just going to delete this. Here we go. Calculate the present value of the future cash flows for the advanced lease payments of $100,000 for the first 5 years. There we go. Insert. I'm going to show you 2 ways of calculating this. Method 1. For method 1, what I need is I need the rate, I need the number of periods, I need the payment, I need the future value, and I need the type, right? And the type, it's 0 if it's paid at the end of the year, and it's 1 if it's paid at the beginning of the year. I know my rate is 10%. And my number of periods, keep in mind, let's just insert an arrow for a second. What I'm doing is I'm valuing these ones. I'm calculating the present value back to this date, January 1st, year 1. That's what I'm doing. When I look at this, the number of payments is 5. And the payment is going to be, and I input this as a negative number, $100,000. And then the future value is 0. And my type, because I'm paying at the beginning of the year, my type is 1. Now, I'm going to do this. I'm going to equal present value. And I've got the rate, the number of periods, the payment, future value, and the type. And you'll notice my value is $416,986.54. So that's my present value. If I just do equal formula text, I can see what my formula is. Keep that in mind. That's how I'm calculating it. Now, I can do a method 2. I'm going to do it over here. Now, I'm still going to have my rate, all the rest of it. Now, for method 2, I'm going to recognize that I don't actually present value the $100,000. I don't need to present value the $100,000 because $100,000 today, the present value of $100,000 that I pay today is $100,000. I'm still going to use the rate of 10%. I'm going to use the number of payments as 4. And the reason I'm using 4 here is because, and I'm just going to insert an arrow again. Okay, and I'm going to change the color of the arrow because when I'm looking at this, I'm actually present valuing only the ones that I have to present value. Change the color, right? Now, am I present valuing these? Yes, I'm present valuing them all the way to here, but I'm only going to present value these 4 payments. I'm not going to present value the first payment because it doesn't need to be present valued. So when you think about that, there's only 4 periods of payment. There's only like one, well, if we count the periods, 1, 2, 3, 4. That's only 4 periods, actual periods of time between one date and a date when I'm going to pay. So this is 4, 1, 2, 3, 4 periods. So the payment is still going to be that $100,000. The future value is still going to be 0, but now my type is going to be 0 because I'm ignoring my first payment because it's not present valued. So I'm pretending that I'm paying at the end of this period. End of this period. And I am. If I ignore this, I'm paying, right? I've got this whole period, and now I'm taking into account this period payment of $100,000 as happening at the end of a year. And it is at the end of a year. So in this case, I'm going to do the equals present value, and I'm going to use my rate for 100,000 future value and my type. And you'll see this is $316,986.54. So that's these four payments, pretending that they're being paid at the end of a period. And they are. They're being paid at the end of the year. I'm totally ignoring this first payment. Now, what do I have to do? I have to add in the 100,000 that I have to pay today. And so if I do that, I end up with the exact same amount. So notice these two amounts are identical. It's not like these two amounts are different. I'm just using different processes to come up with the same outcome, but the two amounts are identical. Now, let's look at the next question. Here it says, calculate the present value of the future cash flows for the advanced lease payments of $58,000 for the last 5 years. Let's just grab this right here so we can see what we're talking about. And I'm going to get rid of this arrow because I don't want that. There we go. Okay, and I'm going to change this from being red to being back to black. Now, what I'm doing is I'm looking at these payments right here. I'm looking at this period of time. And I can do it in two different ways. Let's use method one. With method one, and again, I want to do the rate, all the rest of it, right? So I'm just going to copy that down. There we go. Rate is still going to be 10%. The number of periods. I want to think very carefully about this. I'm going to insert an arrow. Here we go. If I look at these payments and I say I want a present value to this point, right? So January 1st of year 5. So I want the present value right here. What is the present value right here? If you look at it, that's 1, 2, 3, 4, 5 periods. So I'm going to say 5 periods. My payment, of course, is going to be the negative 58,000. And my future value is 0. Now, my type. I'm pretending that this is the end of the period. Well, I'm not even pretending. It is the end of the period. It's the end of this 5th period. So I'm saying this is at the end of the period. This is at the end. 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 That's why my present value is going back to here. This is why when I'm standing in this date, that's the present value I'm looking at. So my type is going to be 0 because at this date, I am seeing this first payment as being at the end of this period, which it is. So I can calculate that as equal present value. And then I've got my rate, number of periods, payment, future value, type, which is 0 because I'm looking at the end of a year-long period. And my present value is $219,865.63. Okay, now I'm going to jump down to the next part so I can do the calculation for the next part at the same time. So I'm still using the method 1. This method 1 is carried forward. So method 1. And I'm going to say it's carry forward from the prior calculation. And that's very important to understand that I'm carrying this forward. So now it says, take the calculation result from above and arrive at the present value of that amount on day 1, at day 1, the start of the 10 years. What is the total present value of leasing the equipment? Well, that's a separate question. Let's just transfer that question way down here. There we go. we're going to do this method 1. So I'm carrying forward the method 1. Keep in mind that I am sitting at January 1st, year 5 in method 1. If that's true, and I want to now take this amount and I want to present value it, I have to, and I'm just going to insert an arrow here. I'm going to take it from here and I'm going to carry it forward to there. Okay, change the color. That's what I'm doing. Let's thicken it a little so we can actually see it. That's what I'm doing. So you think that's 1, 2, 3, 4 periods. So I'm going to do my usual. Oh, went too far. Okay. So now my percentage is 10%. My number of periods, well, I saw how many periods it is. 1, 2, 3, 4. It's 4 periods. So my number of periods is 4. My payment is 0 because I'm taking the future value and calculating what the present value of that one future amount is. Then my future value, well, this is my future value. And now my type. I can actually put in 0 or 1. We're going to test this, but let's put in 0 right now. And we say this because 1, 2, 3, 4. It's at the end of a 4-year period. Let's calculate now. And keep in mind, what I'm calculating is the value, the present value of this future amount on January 1st, year 1. I'm going to say present value of the future amount on January 1st, year 1. This is what I'm calculating. So we're going to do equal present value, and we're going to use our same rate, number of periods, payment, my future value, and my type. $150,171.19. That's what it is. Notice that if I change this to a 1, it makes absolutely no difference. When we're taking the present value of one bulk amount, it doesn't matter whether I put in 0 or whether I put in 1. So I'm going to change it back to a 0. Now, let's switch it and do a different method. All right, now let's look at method 2. And for method 2, I'm actually gonna highlight this method 1, bold, and make it bigger. And then I'm gonna do method 2. Okay, so looking at method 2, I'm actually going to do this diagram again. So I'm gonna copy this because I'm gonna do something different. I'm gonna get rid of this and I'm gonna change these to black. All right, so in method 2, and I need a little bit more space. In method 2, I'm going to say, I'm not going to fool around with putting type 0 in here because the fact is it's not a type 0. It's a type 1. I'm paying at the beginning of the year. So I'm going to use my information the way it should be used. And it's not that it should be used this way. It's whichever way I want to do it. I'm going to take my interest rate as 10%. I'm going to take my number of periods. Now, I'm going to look at it this differently. I'm going to insert my line. There we go. Here we go. Okay. I am taking it back to here. I'm going to recognize that this is at the beginning of the year and that I'm present valuing from this point. So I'm going to say that the number of periods is 1, 2, 3, 4, 5. So I'm going to say this is the number of periods is 5. And the payment is again the 58,000. My future value is 0. I'm going to do it as type 1 because to me, that's the right way of doing it. It's a type 1. So I've got to do type 1 and I'm going to do the present value. So I'm going to do equals present value and I'm going to use this information 10, 5, 58, 0, and 1. And you'll notice that the present value is a different amount. And it should be a different amount because I am only present valuing to here. That's where I'm present valuing to. So remember what we did up here? Remember when we showed that when we were using this, it was the same as if present valuing over 4 periods and then adding that one payment? That's what I'm doing. I'm present valuing for 4 periods, 1, 2, 3, 4, and then I'm adding this one amount. So of course, my amount is higher than if I present value further back, right? Now, remember I said take the calculation from above. I'm going to get rid of these lines. Take the calculation from above and then present value it to day one. If I do that, if I take my calculation from day one, then I'm going to present value this amount all this way. And let's change this color. I'm going to present value this amount 1, 2, 3, 4, 5 periods. So under method 2, and I think I'll put it over here. So this is a carry forward from part B, method 2, right? So as always, I still need my rate and number of periods and all the rest of it. Okay, my rate, 10%. My number of periods, I already counted it, it's 5. The payment is going to be 0. What's my future value? My future value is right here. And what's my type? My type doesn't matter because I'm doing future value. So I could do 1 or 0. It makes absolutely no difference. So here we go. This is the present value of the future amount on January 1st, year 1, but from a different point, right? So equal present value. Rate, number of periods, payment, future value. I forgot to put the future value in as a negative number. I'll fix that in a second. Okay, so I'm just going to multiply this by -1. Look at this. The amount is identical, as it should be. So although we end up doing different things in this interim step right here, the result is identical. I either present value this amount all the way back to here, right, over 5 periods, or I present value this amount all the way back to here over 4 periods. The result, the outcome, is exactly the same. Now that we know that these two methods, method 1 and method 2, end up in the exact same place when we present value them to today, which is January 1st, year 1, we can do the final part of the question. So let's go down to the final part of the question. I'm just going to delete this. There we go. What is the total present value of leasing the equipment? So we're going to look at method 1. I did letter these parts now. So calculating the present value of the future cash flows for the advanced lease payments of $100,000, that's part A. And then I did part B with method 1 and 2. Part C, I did method 1 and 2, but method 1 and 2 ended up in the same place. So here I'm going to do method 1, part A and C. When I'm looking at this, I'm looking at the present value of the first 5 years. So the first 5 years payments we know came from A. We go all the way back up here and we see it's $416,000. So now I have the present value of the last 5 years. And we know the present value of the last 5 years is this amount right here. So the two added together are equal to $567,157.73 with regards to method 1. So now let's look at method 2. And again, I'm going to do part A and C, and you know already what's going to happen. We know that we're taking the present value of the first 5 years, present value of the last 5 years, and we're going to get the total. Present value of the first 5 years, doesn't matter. Method 1 and 2 were identical. And present value of the last 5 years, method 1 and 2, in the end, the final step, were also identical. So if I add these two amounts together, they're going to be the same amount. So notice the only difference between method 1 and 2 is in this interim step. because I'm taking the present value under method 1, I'm taking it all the way back 5 periods, right? So then I only have to do 4 periods here. Here, I'm taking it back only to this point right here, which technically is, by the way, only 4 periods plus this. But anyway, you can see what's happening. I end up in the same place. I end up with the same ending value. So hopefully that's helpful for understanding the different ways you can calculate the present value.